Welcome you all in today's webinar of TradingView with PhillipCapital. Our presenter for today is Mr. Amit Sachdeva, who is our senior technical analyst. In today's webinar, we will be covering some of our top investment picks, views on Nifty, Bank Nifty, commodities like gold, silver, crude. We will also share our views on USD INR. Now, without any further ado, we'll turn the time to Mr. Amit.
I will take this as an opportunity to share my outlook over the market. We'll share what we have done in last week. We will share what and how we are looking forward the market from here on. So to start with, we prepare a weekly report which we publish to our clients. So this will help to understand what was the view which we have carried over for this week. This report was prepared as on 16th of July for the period 17th of July to 21st of July. And here we have covered equities, commodities. So first of all, the people who have earlier attended our webinars, as mentioned, we have been very bullish over the market. And as on 21st of March, as on 20th of March, in fact, 20th of March 2023, we have updated that as per the time study, there is a Gann time cycle study as well as inflection point because of the planetary equinox, and it was coinciding with the price levels. So when time and price matches together, there is a strong signal that the reversal takes place. So this was updated on 20th of March when the Nifty was trading at around 16,860 odd levels, and we have mentioned clearly that holding over and above 16,800, 16,500, which is a strong support zone, and further indicated by the time cycle, there can be a reversal. And in the best case scenario, we will be expecting at least 18,000 levels for Nifty futures. Gradually, we have increased our targets towards much higher levels. And positionally, as we have been sharing since last few months to quarters, that we are in a very strong bull phase with the targets of 20,200 followed by 21,400 followed by 23,000 levels gradually. So these are the positional targets which we have been recommending since last almost 2 years. And we have been in between updating our clients that how the market is looking on a short to mid-term time frame. So this report is going to present what was our view for the current week on a very short-term time period. If we see Nifty futures, which ended last week at 19,598, we have mentioned that the bias remains buy on dip over and above 19,200, 19,000 support zone for the potential target come resistance at around 20,200 levels. And why we have been mentioning that, we can clearly see this chart. This is a weekly graph of Nifty, and we can see that it's moving on a parallel bullish phase. So it's forming higher lows, higher highs pattern on a weekly time frame. And the highs of October 2022, which was made at around 19,000 mark, that has been reached on the higher end in June. So around this level in March 20th, we have mentioned that as per the time and price study, there can be a kind of reversal. Here we can see at least 18,000 mark. And it was further confirmed on the weekly basis by a weekly bullish candle on the weekly charts. And thereafter, we have been continuously revising our targets on the higher end, keeping a cautious approach towards the resistance levels. 2 to 3 weeks back, we have seen that Nifty has given a breakout over and above 19,000 mark, and this was a consolidation breakout of last almost 1.5 years. So we have been very bullish that we were expecting that at least another 2,000 points on the higher end cannot be ruled out. That gives a target of 21,000 plus levels. But on a short to mid-term time frame, the immediate target recommended was 20,200 followed by 20,500, which was a kind of cluster zone. Here, the point to note was that even on the weekly time frame, the index has entered into an overbought territory. And that was the reason we have been slightly cautious at all resistance levels at the higher end. But the point to note is that if we see previous bull market studies, immediate bullish phase of 2003-2006 bull market, there we have seen that the index, in spite of reaching into an overbought territory, that's not only the criteria that the reversal will take place. We have to keep into consideration other factors also while judging whether the market is still in a up move or a reversal will be expected. So according to our previous experience of last 18-20 years in the market, we have been running with a positive bias only. We have not recommended any kind of selling. The only thing which we have recommended to our existing clients that look for a quantity management. That since we are in a very strong bull market and we will be expecting much higher levels, it will be very, very important to manage your quantity and risk. And what is the quantity and risk management? Whenever the index reaches towards a crucial hurdle, you need to look for some kind of proportionate profit taking. Dips, if any, would be looked for fresh entry, else a breakout. If of that consolidation zone, we can add on the positions. So it's all about the quantity management and rotating your holdings from one segment to other segment or keeping in hold your delivery bets. So here what we have recommended is that since the index has given a breakout over and above 19,000 mark, on the immediate basis, it should head higher towards 20,200, which was a price study, a harmony price study target. And at the same time, 20,000 odd levels has been a psychological hurdle. Since in last 4 months, we have seen that Nifty has gained almost 18.5% from the lows of 16,866 to current highs. as well as Bank Nifty has gained almost 19.5%. So it's a very fast up move in a span of just 3-4 months. So we were expecting some kind of pause, but looking the momentum and the sector rotations, it was clearly visible that the indices are heading towards higher levels. So accordingly, what we have done in last few weeks to months is that we have looked for those momentum based counters, and we have recommended our clients to switch from one counter to another as per depending on the momentum. Apart from that, the mid cap ideas have been recommended to our clients, which we have held for much substantial period of time. For example, Mesdog was recommended at around 600 odd levels for the target of around 1200, which was revised to 1800, 2000 mark, and currently it is trading around 8000 level, 1800 mark. So we have to follow the momentum. If the strength is there, we should continue with the holdings. If we believe that there is going to be a weakness, or things are, or indicators are indicating that there can be a pause or profit taking, we have to act aptly. So bull market, whether of multi-years or multi-months, it's all about being in the right counter with the momentum, holding the right quantity. Then only you can enjoy the actual bull market. And we have been recommending accordingly since last few quarters. Last week, we have mentioned clearly that holding over and above 19,200, the bias will remain positive with a potential target of 20,000 mark, which is important crucial level. Overall, the bias is buy on dip till the time index is holding over and above 19,200, 19,000 zone. At the same time, in Bank Nifty futures, which ended last week at 44,903 mark, there also we have said that holding over and above 43,800, 44,000 mark, which was an immediate short to midterm crucial support level, till the time it is holding over and above this zone, that is 44,000, 43,200 mark. The bias remains buy on dip for the potential targets of 45,680, followed by the major target of 46,950. And we have seen that index has made the high of 46,360 this week. So the bias continues to remain positive. And here also what we have seen is that if you see this weekly chart of multi-months time frame, we have seen that the silver line at around 42,000 level has been breached on the higher end in mid April 2023. So that was an indication that it is forming higher highs, higher lows pattern on a weekly time frame, and the index is open towards the higher levels. So it's only the price and the volume parameter which can guide and help us to write the basic main momentum of the market. Apart from that, we also look open interest and other peripheral indicators in order to be with the right flow of the market. So here in Bank Nifty futures, we have been clearly indicated by the price study on the weekly time frame that holding over and above 42,000 levels initially, the bias will remain positive. At least it will go and test the previous highs of October 22, which was close to around 44,000 mark. So in line with the expectation, we can see here clearly that it tested exact high of 44,000 mark. It spent few weeks, and then we have seen a kind of sector rotations in Bank Nifty. Last week, it has clearly formed a bullish engulfing candle on the weekly time frame, and the closing was well above 44,000 mark. So that itself was an indicator that the index is heading higher towards 45,680, followed by 46,950 odd levels. So in line with the view, we have already achieved the highs of 46,360. As per our write-up, we have mentioned clearly that for the coming week, range to positive is the outlook. Buy on dip remains the view over and above 43,800 with immediate target resistance at 45,400, followed by 46,000 levels on a conservative note. Same was the case with Nifty. It's a very clear and crisp graph. You can see it's forming a higher highs, higher lows pattern with a vertical support trend line. And in last few weeks, we have seen that it has given a breakout over and above falling trend line resistance. So it was expected to test the higher levels of around 21,000 mark on the higher end. But the only factor which we have seen last week in Nifty was that it formed a kind of bearish, hanging man pattern kind of candlestick, which indicates that the upside will be capped. So last week we have mentioned that though the bias continues to be positive over and above the support of 19,600 mark, Nifty index is expected to witness resistance towards the move of 20,650. Now, if we see exact high of this week for Nifty, it was close to 20,670, which was at around resistance levels, and thereafter it slipped down marginally. So that is the beauty of price study and the volume study. If you are in sync with the momentum, it's very helpful for you to take the profits at appropriate levels and to manage your risk and quantity. Now, Nifty Midcap Index, this was the index which we are tracking on a very keen eyes. The reason was that it was the first index which has given a setup and indication and signal that the index has bottomed out close to around 25,000 mark. So this was the first index which has given a breakout of its consolidation zone also. So it has given an indication that even the Nifty and Bank Nifty can follow up, because the Nifty Midcap Index has given the breakout. Now the point to note is that in last 4 months, Nifty has gained around 18.5%, Bank Nifty has gained around 19.5%, and the Midcap Index has gained around 26.5%. So it has clearly outperformed Nifty and Bank Nifty, and that's the reason if the Midcap, we can find that there is a quantity buying and delivery buying in Midcap. That means the sentiment at behind the curtains in the market is positive. And that was the reason we have been following Nifty Midcap Index with a keen eyes. Now in last few weeks, we have seen that it has entered into an extreme overbought territory and close to the resistance of around 37,000 mark, which is a cluster resistance zone. What do you mean by cluster resistance zone? Cluster resistance zone is the resistance zone which comes from different studies. For example, here we can see that it's a parallel channel. That these yellow level lines indicates a parallel channel. So 37,100 is close to a resistance level. Followed by this 37,000 has been also figured out from our different price studies, harmonic studies and Fibonacci ratios, as well as from other harmonic price studies. So this was a clear resistance for Nifty mid cap, and being in an extreme overbought territory, that was a signal that any move toward these levels, at least some profit taking should be looked into. We were expecting that from these levels, 37,000 odd levels, it can retrace back to 35,000 and maybe lower levels once. That will be tracked on a weekly basis as per the strength and the momentum. But precautionarily, we have mentioned that at least on a counter specific manner, look for your holdings, which are the counters, what are the major positional targets and resistances, and accordingly look for some kind of profit taking. Reason being, the index as a whole has approached towards the highs and towards the resistance level. Now, if we see this week, it made a high of 36,966, which was close to its 37,000 mark, and from those levels, it marginally slipped down. So the people who have read our reports should have looked for some kind of profiting around those levels. They must have booked, and it will provide you a fresh opportunity at a lower support levels of 35,000 and maybe lower thereafter in case if we witness macro level jitters. But overall, we are expecting that any kind of dips will be looked as a fresh opportunity for going long for the potential target of 37,100, followed by the higher levels of 39,000 mark. Now, Dow Jones has been underperforming, and since last few quarters we have been mentioning, even at the start of this year, we have mentioned that Dow Jones should underperform compared to the Nifty. The reason was that the pattern and the setup, which was not very bullish compared to what we have seen in Nifty. Dow Jones last week ended at 34,500 mark, and now if you see this weekly chart, we can see here that this falling trend line, black color, that has been held for last 4-5 weeks. And the support was for this Dow Jones was close to 33,500 mark. So what we have recommended is that holding over and above 33,500, Dow Jones will be open towards a major resistance of 35,000 levels. Within this setup, we can figure out one inverse head and shoulder structure, and this pattern is bullish in case if the neckline of this pattern is taken off with conviction, and the neckline comes at around 35,000 mark. Now this week we have seen that Dow has surpassed this neckline and it is trading close to around 35,370 was the high. The current price is around 35,200 marks. So on a weekly time frame, if it holds above 35,000 odd levels, that will be one indication that Dow is open for higher levels. Though 1 or 2 weeks closing is not going to make much difference, reason being this structure is of almost 9 to 12 months time frame. So at least on a monthly time frame, we should get a signal that Dow Jones has surpassed and sustained over and above 35,500 levels, and in that scenario it will be open to the highs of 37,000 and maybe higher thereafter. So if we are going to witness any kind of buying interest at a global market, definitely our domestic market is going to be in sync with it, and we will be expecting higher levels there also. So this Dow Jones is going to be a very, very important for a week and so time frame in order to guide the global market momentum. Since at domestic market we are close to 20,000, which is a psychological hurdle, as well as per the price study also it is close to the resistance and trading in a overbought territory. So the risk reward ratio for fresh long in Nifty is not very favorable. But in case if we get a breakout in Dow Jones, then we can expect some kind of higher highs and higher lows pattern even in the Nifty, and in that scenario it will be open towards higher levels. So we have to keep an eye on Dow Jones for next few days to week, and holding over and above 35,000, 35,500 mark on a weekly time frame especially, that can be a kind of signal where we should look for further up moves in days to come. So here we have clearly mentioned that keeping the stop of 500 odd points on the dips towards 33,500 odd levels, we can look for going long, and at the same time 35,000, 35,500 can we look for contra trading shorts, because we have seen in last 9 to 12 months that zone is acting as a resistance. So for the high risk traders, that definitely is a good risk reward ratio for contra shorts. But you need to keep a strict stop loss of 500 odd points, and we are expecting that once it's sustained about 35,500 mark levels, the shorts which are in the system in Dow Jones, that can also run for covering up to an extent. Moving towards commodity, we have been very bullish on gold since last few quarters, and as per the price study, we have been playing this with a positive outlook. If you see on the weekly time frame, we have got a kind of breakout over and above 52,000 levels, and as per the price study, we have recommended the targets of 62,000 followed by 64,000 in gold. It made a high of close to 62,000 levels, and thereafter slipped down back to the close mentioned support of 58,000 mark. So the major trend continues to be up, and we are expecting even the gold to head higher once again towards 61,200 followed by 64,500 mark. Now the only concern with these charts are that since these counters have gained substantially in a short period of time, consolidation takes place. For example, if you see gold, it has made the highs of 62,000 levels from the lows of 49,000 mark in just a span of 3 to 4 months. So when such fast movement comes, things turns into a overbought territory. All the indicators, peripheral, whether this RSI or MACD, they indicates that there is a kind of hurdles at a high levels, and if that coincides with the price hurdles, and it also indicates from your derivative studies, then definitely there's a high probability that the counters or the index enters into a consolidation for some period of time in order to cool off the oscillators. But that doesn't change the major trend. For example, even in the gold, from 62,000 to 58,000 mark, that's just a kind of profit taking or consolidation which we have seen, but that is not going to change the major trend, which is bullish in nature in gold, and we are expecting gold to head higher in weeks and months to time frame, expecting target of 64,000 and high levels. Same is the case with silver. We have been playing this counter with a positive outlook from 52,000 high levels for the potential target of 80,000 levels. Though it was quite short of 80,000 in the last few months, we have seen that it made a high of around close to 77,800 mark before slipping down sharply towards 67,500. So this is a high beta counter compared to gold. This is a high beta counter, and that's the reason it's very volatile. We have mentioned clearly that now it's very prominent from the chart also. If you see this weekly chart, this was a kind of parallel consolidation phase. Okay, so earlier there was a bullish trend, bullish move from the lows of 35,000 to the highs of 75,000. This was an impulsive up move. Now this impulsive up move has entered into a time and price consolidation within a parallel channel. Now the only concern was that since last few quarters we have been expecting, even in mid of 21-22, we were expecting this channel to break out and move towards 1 lakh levels in silver. Amid global turmoils and all. But what happened is that this consolidation phase prolonged and extended. So this was an extension. Ideally, in ideal case scenario, way back in Jan and March quarter, we were expecting gold and silver to give a breakout from these levels and head higher. But it preferred to enter into a consolidation for another 12 months or time period. But as mentioned, the consolidation doesn't change the major trend. We have to keep in mind what are the major support levels where we can look for fresh long entries, or where we can look for a contra play, and thereafter capitalize the moves. So it took more time. Then it gave a breakout over and above 68,000 mark in March 23. It tested the highs of 78,000 mark before retesting the support zone. So this parallel, as per the thumb rule of technicals, when our resistance has been taken off, it acts as a support. So here we can see on this chart, this was earlier a falling trend line resistance. The resistance breakout took place, and then the retest of support, that resistance which is going to act as a support, has been done, and that has provided a better risk reward ratio for the people who have missed the opportunity here for going long. So from 67,500, 68,000 mark, we have seen a clear sharp up move way back to 76,000 levels. So last week also we mentioned that the bias continues to be positive, but on the higher end 80,000 can be expected. As per the derivatives further studies on a weekly basis, we have figured out that there is a call writers which are standing close to around 78,000, 80,000 mark, that indicated that this level is not going to be broken up easily. So looking the data and the other peripheral indices, you define the intensity of the bullishness or bearish over the market. So though we are bullish over the gold and silver, but looking the data in between, we can modify and retune our positions. For example, in silver and gold, we have seen that there is a lot number of option sellers out there, is a huge buildups, which indicates that at the higher end, it will be difficult for these counters to sustain, and it can retest the lower levels. So that gives us that we cannot be very aggressive. We need to be moderately bullish, or we can at least use options in order to play theta or otherwise. So in silver also, what we were expecting that this counter should head higher towards 80,000 mark, but during the week we have seen and figured out that there is a strong open interest buildup, which indicates that sustaining and surpassing 80,000 odd levels will be difficult, at least for next few weeks. So it can re-enter and can enter into a consolidation zone between 73,000, 80,000 mark. So how we are going to play this view? We need to be long, and at the same time we need to be covered. So either we can look for selling options at the higher levels, or we can buy puts in order to hedge our long positions. So there can be a number of strategies which you can use in order to play any kind of view, whether it's a mild view, aggressive, mild bullish, moderate bullish, aggressive bullish, or super aggressive bullish. So these are the conclusions which you draw from your data study, price analysis, volume studies, and derivatives, and then you strategically plan your strategy, that in what way I'm going to play this view. So it is important to finalize your view, then to strategize your view, and then to execute your view, and then to modify your view as per the momentum and other interim data. So these 4 factors are very, very important for any kind of trading opportunities, profitabilities for the traders. If you are missing any of these, then the probability of making a consistent winning trades will be difficult. So data analysis, then your strategies, then your executions, and then the follow-up of executions and modifications. If you're doing all these 4 acts wisely, then the market is going to reward you consistently with profits. And definitely the risk management as per your quantity and capital appetite is very, very important in any of the market, whether it's a bull market, whether it's a bear market or the consolidation zone. It's all about your risk management and the studies. Crude, we have been playing earlier bullish bias, then we have been playing with a negative bias, because if you see this chart, this was a strong bearish candle which was made earlier in 2021, which has indicated that now it has formed a kind of lower top, double top come lower top with a bearish engulfing, and we will be expecting to retest the lows of 7,000 and maybe lower. That will be defined in future. So we have been playing this counter with a negative bias, though at the lower levels we have tried to play a contra play for the pullbacks. And in last 4-5 months, we have been mentioning our clients that this counter is trading in extreme oversold zone, and we will be expecting some kind of pullbacks from the lows, but with a sell on rise outlook, because the mid-term trend continues to be down. Short-term trend is in an oversold zone, so neither we can be very bullish on buying on the lower end, or we can be bullish on selling at a higher level. So now this kind of view can be played with the option strategies as mentioned. So here what we are doing and what we have recommended last few weeks is that we have gone long in futures, we have sold options at the higher levels, or we have gone for the ratio spreads or the with a bias of pullback, and at the higher levels we have initiated strategy with a bias of downside move. Now in the last few weeks we have been again playing with a positive bias, and even for the day traders or the short-term traders we have recommended ticket calls and puts as per the momentum. So what we are expecting in crude oil is that the upside is capped. The midterm trend continues to be sell on rise. The important levels are 6,400 and 7,000 mark. Initially, we see this week it made a high of 63.15. In last 3-4 weeks, we have played this counter with a positive bias from 5,750 odd levels. We were expecting a pullback towards some 6,400 mark. So that has been almost achieved, and now we are looking for a kind of short trading bets close to around 6,400 mark, keeping the stock over and above 6,500 mark. If it holds above 65, then we will be expecting it to head and test the major resistance of 7,000 mark. Till crude oil is trading below 7,000 mark on all 3 different time frames, the bias will be sell on rise. Same is the case with copper. Copper has been moving with a rising channel trend line support. So 680-700 has been recommended to be a crucial support zone for bulls since last few weeks. At the same time, we have mentioned that 760 and followed by 800 mark that can be looked for contra trading short bets. So more or less it is trading within that range. USD is also within a range. Only we can see since last so many months it has been trading within a range of 81.50 and 83 levels, and we have been mentioning that go long, buy on dips is the outlook. Positional in USD, hedge yourself with writing options in order to play theta. Now a couple of counters which we have recommended last week was, one of them was TCS. Though TCS we have been playing over and above 3250 odd levels with a positive bias. Expected target was around 36,050 to 37,000 zone. Now if you see the chart, this is a falling trend line resistance, this black line. Okay, now within that black line we can see that this was earlier a rising trend line which was broken down, retested. The support turned out to be a resistance. Again, multiple times it retested that level resistance, failed to surpass, and then slipped down. On the lower end, it has formed another support level. It was last week we have seen a kind of breakout of this falling trend line resistance. But at the same time, what we can conclude here was that any pullback towards 3650 to 3700 levels should be looked for contra trading shorts. And that was the reason we have not been very bullish on this counter. And I will be just sharing our slides also where we have cautious our clients during this week in TCS post result that this counter can slip down. We can see easily from the derivative segment that the upside is capped. Another counter was Biocon. We have been playing this counter with a positive bias over and above 220 levels. This counter has been in extreme oversold zone. It formed a kind of double bottom close to around crucial 200 levels, and from those levels it bounced back towards the highs of 260 odd levels. So we were expecting a follow-up move towards the highs of 285 to 300 levels, which was a contra trading short opportunity level. So these were the 2 trades which we have recommended, apart from the monthly trades which we generally publish on first week of every month. Now I will be just sharing few slides where we will be discussing what we do actually during the market hours with our clients. So now if you see here, as mentioned, we have recommended TCS at the start of this week with a positive bias. But on Tuesday itself, what we have mentioned is that TCS has a strong hurdle at around 3,500 mark, and this was purely based on the derivative study. And we have at that point of time TCS was trading at around 34.98. So what could have been acted on this advice? The people who are holding TCS should have either hedged themselves, should have reduced their positions long side, or should have traded stop losses. Same was the case with Infi, which was close to trading at around 14.48. We have mentioned as per the derivatives that it has a strong hurdle for the July series at around 1,500 mark, and we will not be expecting these counters to sustain beyond these levels. Now, apart from that, what we generally do is that whatever trades we recommend during the days, during the week or the months, we give a follow-up to our clients. For example, in ICICI Bank, we have recommended a follow-up that yes, this target has been achieved. Look for some kind of profit taking. Same is the case with Zensurtech, which we has gained almost 28% from our recommendations. So on and so forth. We give an outlook on a positional time frame to our clients. We give the follow-up of our trades. For example, today in the morning, what we have recommended is that post market opening that was close to around 10:15, that as per the study and the setup, upside is capped and we can expect lower levels. The lower support levels will be around 19,740, which can be looked for contra trading longs. At the same time, for the option players, what we have recommended is that look for buying in 19,900 put for 27th July expiry. For the day players, at that point of time, it was trading at 148. We have recommended buying on dips. It made a low of 120 followed by the highs of around 178. So it has surpassed potential targets. So sorry, it made a high of around 216, which has surpassed our second target also. So these are the way how we guide our clients, the retail as well as the ultra HNIs. So if you find our content relevant and if you want to get associated with us, you can contact us on the given mail ID and the contact numbers.